Hey everybody, Ted Bauman here with my weekly video for you. This week's topic is income. In other words, investing in assets that generate income. Why is everybody so keen on that right now? Well, here's a chart that suggests why. This is Kathy Wood's flagship ETF ARKK, the one that holds all the disruptive world-beating companies like Tesla and Zoom and others. And that's a pretty sorry picture. Basically, that is a strategy that is not working at the moment, and you can see that it's really testing medium-term support and could even fall to levels that we saw even before that fund began to emerge into the public consciousness back in 2017-18. So things are not looking good on that kind of forward-looking strategy. So in the absence of good news on the speculative front, people are turning to income generating assets, particularly stocks and funds that produce dividends. And people have asked me to talk about them. That's what I'm going to do today. Why are they attractive? First of all, they generate a yield. And if that yield can beat inflation, then that means that at least your assets are rising in value larger than inflation. Now that we have to be careful there because the share price of an asset and its yield are two different things, but at least you're getting income from these kinds of investments. You can easily beat inflation. I'm going to show you just now. And if you, for example, were to invest in a fixed income bond market, you would still be way below inflation because, for example, the 10-year yield is under 4%, whereas inflation clocked in at 7.7% last month. So that tells you that if you can find assets that yield more than the current inflation rate, you're winning. That's why people like them. The second one is that assets that generate that kind of income imply that there's cash flow, and cash flow is valued in a weak market because obviously you're not going to win with a strategy like Kathy Wood's right now, but you can win if you can find good high yielding stocks and funds and other assets that can generate cash flow. And the market likes cash flow in in tough times because cash flow means business success. That leads them to be more suitable to a defensive strategy and more stable. It means they have less volatility. Not all income assets escape volatility, but generally speaking, they tend to be less volatile than the market as a whole. That makes them popular during these times. The fourth big issue is that the macro environment has changed. We no longer live in an easy money environment. We no longer live in an environment where people are willing to wait long periods before companies generate cash. They want companies to succeed now. And that means that by comparison with everything else on the market, and again, use ARKK as a proxy, these things are simply more attractive. They're even more attractive than bond rates, which I'm going to explain in a moment. The fifth thing, and here's a big one, is that a lot of people misunderstand the opportunity, particularly from funds that pay dividends. They don't understand how the fund works. They don't understand how it generates income. And so they end up mispricing the fund, which leads to its stock trading at below its net asset value, which basically means that if you own a share in this company, the purchase price of that share can be up to 10 or even 20% below the actual underlying value of the assets that the fund itself owns. And when that kind of mispricing happens, the market tends to notice and people jump in, and that leads to price appreciation as well as yield. Now, what kinds of fixed income assets are we talking about? Well, or income assets. There's fixed incomes, there's bonds like treasuries, direct ownership of corporate bonds, and so on. There are preferred shares, which are a form of hybrid equity and credit that pay a fixed income from them. And then you get credit related assets that pay a fixed amount because they are related to a credit instrument. Then you get variable yields. Basically, you get companies that may change their yield from time to time, may issue extraordinary extra dividends, and so on. So fixed versus variable is the first thing to bear in mind. The second thing is the distinction between single companies and funds. For example, you can buy a real estate investment trust like a REIT and get a decent yield, or you could buy a fund that holds a whole bunch of REITs, and that gives you diversification, and it also gives you management, the people who are running the fund that brings all these income producing assets into it. They're doing the heavy lifting for you. You're going to have to pay them something, which I'll talk about in a moment, but often that can be a better strategy than just trying to buy the individual ones. The next distinction that's important is when you buy funds that invest in credit markets versus equity markets. paradoxically, you have less risk of capital loss if you buy funds that generate income by investing in credit markets, because credit tends to retain its value. It's unless there's a collapse in the credit market and the economy completely falls apart like it did in 2008, 2009, most debts retain their value, whereas company equity can go way down. I mean, a company's stock price can go way down, but its debt is still its debt and it still owes it. And so funds that own debt tend to do better in volatile times. Now, what should you be looking for when you go looking for income assets? First of all, expense ratio. You want to know how much the management of the fund is charging for that service. And there's a lot of misunderstanding about expense ratios. It's not a direct offset against the dividend yield that you get. Instead, the expense ratio of an ETF or a closed-end fund or something that generates yield is basically the money that the fund management takes from its current value at any given time to pay for its management activity. And you want to get the lowest you can. Now, in some cases, they can be under 1% or even under 0.5%. But in other cases, expense ratios north of 2% are justifiable if the fund performs really well. The second thing to consider is the dividend history and the safety. Has the company or the fund or the ETF got a good track record of being able to pay its dividends? Has it raised them over time? Is it rated, are its dividends considered safe? You can go to a place like Seeking Alpha and you can see the dividend safety scores for all kinds of things. Third thing is yield versus distribution coverage. Are they making enough money to cover their yield? That's easy to find out. Again, you go into websites that have information about these and they'll tell you whether or not they're making enough. Be careful, though, that the typical way that a lot of financial media covers things like dividend coverage does not always work in the same way for dividend producing assets like real estate investment trust. And people get confused because they see a dividend coverage, which, it seems like they're paying out more than 100% of their income. That's because the software that runs these market list of tickers is oriented towards individual companies and not REITs. I talked about that when I was writing the Bauman letter. But basically, you just need to understand that it's not always the case that a distribution above 100% is a problem. But you do need to understand the specifics of each one. The last thing, of course, is net asset value versus fund value. All things being equal, you want to buy into a fund, for example, like a closed-end fund that is trading at below its net asset value, because that means that there's a good chance that it will be able to catch up and you'll be able to make some price appreciation on your investment as well. Now, sometimes funds trade below their NAV because they're badly run. And obviously that's something you want to be aware of and not do. Now, what about a yield and gain and total return? Because remember, yield is something that you get, as long as the asset is paying it, you're going to get that dividend. I have investments in my own portfolio that yield 10, 11, 12, even up to 14%. And as long as that yield continues, I'm getting that money every month or every quarter, right? So if I were focused on current income, I'd be happy to own those. But if you're not yet retired and you're trying to build your kitty, you also want to be aware of the gain of the price of the underlying share, because the yield plus your appreciation or depreciation of the price of the asset is what gives you total return. And over time, if you're not yet drawing income from from these assets to fund retirement, for example, the total return is really the important thing you want to do. So generally speaking, if you are young and just getting started, focus on total return. As you get older and get closer to wanting to pull out income, focus on yield and, of course, safety. Now, one of the key things that you can do with any income producing asset is to compound it by taking the income you get and having it automatically reinvested back into the shares of that fund or company, which then increases the amount that you get the next time there's a payout, and so on and so forth. And the mathematics of this, I mean, Einstein said the one great thing in the world, the greatest scientific discovery or mathematical discovery that he ever made was compound interest. And that's because it leads to an accelerating rate of growth in the value of the asset over long periods of time. So even if you start by buying a relatively low yielding asset, something that maybe pays 2.5%, 3%, By compounding that over long periods of time, you can end up with fantastic returns. On the other hand, there are plenty of assets that do pay very high yields, current yields. And generally speaking, they tend to be in the fund category, closed-end funds, which I'm going to talk about soon. But essentially, that is, one option is to just focus on current high yield. Of course, you can also reinvest funds into those, reinvest your dividends back into those big, fast, or high-paying assets, and also take advantage of compounding. Now, the third big strategy, of course, is to buy a company that has a tendency, or a fund that has a tendency to increase its yield rapidly over time, because those are the companies that tend to end up providing you with a high yield on cost over time. Now, let's talk about funds, because they are my favorite type of investment for income. Roughly 1 in 5 tickers on the New York Stock Exchange are closed-end funds, or CEFs. They've got about 250 billion in market value, and they can invest in pretty much anything. So let's talk about the differences between closed-end funds and mutual funds, which you probably know if you have a retirement account. They both have an underlying portfolio of investments that has value, and both distribute income through capital gains, and sometimes through, dividends plus capital gains, and so on. Both are actively managed. They both have expense ratios and fees. But traditional mutual funds issue and redeem shares daily at the fund's net asset value. So it never trades away from its net asset value. And of course, with a mutual fund, you can only buy and sell it to the company that issues it, like Fidelity or Schwab. On the other hand, CEFs trade on an exchange all day, just like a stock. The share price for a CEF is set by the market, and the share price rarely equals the CEF's net asset value. The other thing about CEFs is that they are pools of capital that are issued once. They are issued in an IPO like any other kind of new launch. And then once they're out there, basically there are no new additions. There are no new shares. No new money comes into it. You're just basically owning a pool of capital that is generating income. So that actually gives you a bit of an advantage, because it means that they're focusing on that as opposed to doing crazy things like investing in flying cars. Now, CEFs can also invest in debt. They can issue debt. They can use preferred shares to leverage their asset, and that leverage allows them to increase distributions. It makes them somewhat more volatile, because as credit markets change, it may affect the way the market views particular CEFs. But generally speaking, CEFs are able to increase their yield vis-a-vis individual companies and other types of investments like ETFs, because they can use leverage. Now, what about ETFs as opposed to CEFs? Well, again, they both have investments with value. Some of them, many ETFs pay out dividends, but ETFs tend to trade very close to their net asset value, because that's what they're designed to do. Whereas CEFs can trade at a premium or a discount to NAV, and that gives you that income opportunity, that opportunity to buy low and then have the price of the CEF rise back to its NAV. ETFs generally don't require as much management as CEFs, which means their expense ratios are a little bit lower. But the key thing for me is that both of them are sensitive to ups and downs in economic sectors that they focus on. But ETFs tend to track much broader industrial classifications than CEFs, which tend to hone in on specific industries. And that gives them the opportunity to really focus on a set of companies that can produce very high yields in CEFs. So the yields on CEFs tend to be much higher than you will get in comparable ETFs. Now, both trade like exchanges on a stock, and the portfolios of both can be leveraged. But the critical thing is that CEFs, because they can use a different kind of leveraging approach, they can actually generate much higher yields and return than ETFs do. All right, so my preferred approach to income assets is right now CEFs. I own a lot of CEFs, and I can tell you right now that the yields that I'm getting my portfolio has outperformed the stock market this year by a factor of 5. And that's because I have focused on income. I've focused on recycling all the dividends that I get back into the funds. I've been very careful to try to pick funds when they're at their bottom, and to buy them at a discount, so that I can also get some price appreciation, and of course, lower yields on cost. I can lock in, or higher yields on cost, by buying cheap and having the dividends rise. Now, what sectors do I like? Well, right now, I think corporate debt is an important one, just as I explained a moment ago. Corporate debt is paradoxically more stable than equity CEFs for the simple reason that debt has to be repaid, whereas share prices can go up and down all they like. And because of that, right now, I think that the big question, of course, is what's happening with interest rates. Is it going to put pressure on some of these ETFs, for example, that hold high levels of junk debt? Well, right now, we're just not seeing that kind of stress. And good CEFs anticipate this stuff, and they're diverse enough, and they have enough different types of assets that they can get rid of those kinds of assets before they have real problems. So, in that sense, I think the main thing is that I'm focusing on credit markets and credit debt and not right now on equity. The second thing I'm focusing on is energy. You get CEFs, for example, that hold master limited partnerships as part of the the overall portfolio that they have. And of course, those things can generate very high yields. And instead of directly owning the CEFs, you own, the MLPs, which exposes you to tax complications. You own the CEF, so they have to deal with the tax complications. But basically, those are two sectors. The third one that I like is preferred shares, because you get CEFs that specialize in buying preferred shares of company, which are like a form of equity. They're the way companies raise money. They pay fixed coupons, and of course, they can use various types of leveraging to increase their incomes and actually pay higher yields than the underlying preferreds themselves. So I like CEFs. Now, where are you going to find them? Well, there are three CEF ETFs, and I'm not recommending that you buy the ETFs, although here's the table. You can see they have pretty good yield. CEFS yields about 9.25% with a 2.9% expense ratio, which is pretty high. If it were a normal ETF, it's probably a little bit high even for a CEF ETF. But as you'll see, it's not a deal breaker in this sector. The next one is YYY, which is an equity-based one, but which is yielding about 8.9% right now, because it's a high dividend-paying equity ETF, and its expense ratio is a little over 2%. Then you get PCEF, which is another equity-oriented CEF, but ETF, and it's yielding 6.6% with an expense ratio also of a little over 2%. Now, the reason I give you the ETFs is because I would encourage you to go onto your favorite financial website, click or enter those tickers, CEFS, YYY, and PCEF, and look at their holdings, and then look at the underlying distributions that they're getting from those holdings. So remember, these are ETFs that hold closed-end funds, shares in closed-end funds. So the underlying funds that these ETF owns are where you should be looking. That's all from me today. I'm encouraging you to ask as many questions as you like, and I will be glad to answer them. Next time, I'll be reporting from Cape Town, South Africa. I am leaving tomorrow at about noon, and I will be down there from Thursday until just after New Year. Then I'll be back in Atlanta. Take care, everyone.